Lending Technology Think Tank. My name's Colin White. This is the third session of our event today. If you've missed it, the sessions that we had earlier covered credit risk, and we also looked at measuring affordability in the last session. So they've been recorded, and they'll be able to view at a later event. But we just want to move on with our third session today shortly. Hopefully we can get some more interaction in this session. Really quick, brief run through, if that's okay. If you can use the panel in front of you in terms of the options you've got to click on, there's an opportunity to find out more about today's speakers. You can download a little bit of, or there's some web links that you can click through to for more information about other events that we've got. And there's also information on our sponsor Experian as well. So I'd like to say thank you to them for their support at this event. But the other thing I'd like to draw your attention to is the speech bubble. If you have a look at clicking on that at some point throughout the event, feel free to plug in and ask some questions, type them in, and we'll share them with our panel. It'd be great to get any thoughts and feedback as well on the event as well, any comments even, that would be awesome. Also socially, through the LinkedIn and Twitter feeds as well, using the hashtag LendTechTT, that would be awesome. But let's move swiftly on with our third session today, which will discuss regulations' impact on lending. And helping us through today's event by chairing it has been Chris Warburton from RO Strategy. He's going to quickly introduce the topics, and but before that, he'll introduce the panel to you. So, Chris, over to you.
Thanks, Colin. So, welcome back, everyone. Those who went on the previous sessions, my name is Chris Warburton. I'm going to be the chair for this event. A little bit of my background, I spent the last 20 odd years in risk operations, looking after everything from credit risk underwriting, all the way through fraud and collections. And I think we had a really good day so far. We're talking a bit about credit risk and cost of living challenges. We talked a little bit on the last session around measuring affordability, and then this session here, we're then going to talk a bit about regulations and the change that's having on lending. Before we then go into the last session, which is then really around digital lending technology. So this session here is really around regulations and impact on lending. We've got three really great panelists. Just to chat through the various issues that are going on, because there's not much going on in regulations at the moment. So we got Jason Wassell, who's the CEO of the Consumer Credit Trade Association. And they're obviously the Consumer Credit Trade Association, the alternative home for alternative lenders, the home for alternative lenders, sorry. We've got Sheraz Afzal, who's the Chief Risk Officer for the Quint Group. And the Quint Group are a financial technology group really around improving access to credit for customers. And then last, we've got James Ellwood, who's the Senior Relationship Manager at Billings Finance. And they're a vehicle finance company, and they're in the vehicle motor finance area. So the three of you, thank you very much for joining, and it's great to have you here. So to start off, I mean, as I say, there's not much going on in regulation much at all, as I said jokingly. I'll talk a bit about the elephant in the room first off, which is consumer duty. So we've got 4 months to go. There's been a lot of talk about it. I mean, what do you think the state of readiness is in the industry for the implementation at the end of July? I mean, Jason, do you want to maybe go first? You're probably close to it for at least for some of your members, but also what you've seen sort of wider in the industry.
I think it'll be interesting, because I think all three of us will see lots of other lenders and brokers and other. So we'll all three of us will probably see what's happening across the environment. But I think for me, obviously, I listen to my members. I also listen to other lenders that are in other trade associations as well. So I get to see across the landscape, and it is a polarized position, I would suggest. Some lenders I talk to see this as a real radical shift, and that this requires us to go right back to the beginning and start asking some fundamental questions about the nature of the customer, the nature of the need, and what that means in terms of product and delivery of that product, what that means in terms of good outcomes as well. I think we see that. Certainly that's one group of lenders and brokers and other associates. I think there is another group that I see and talk to that surprised me by saying that this is just treating customers fairly with a different badge, and that maybe there's a little bit more paperwork, but it is just treating customers fairly. And because we're 100% on the ball with treating customers fairly, then this is not a problem for us and shouldn't be a problem for us going forward. And interestingly, you see lenders and brokers within certain subsectors have all kind of convinced themselves that they're fine, particularly areas that have not had interventions in the past. I think where there's been interventions by the FCA and by FORS, and I think that they're taking this a lot more seriously.
I mean, James, I mean, you obviously work across brokers as well. I mean, what are you sort of seeing in terms of readiness in the motor kind of sector?
Yeah, well, similar to what Jason has said there, it's a bit polarizing. A lot of the brokers I speak to at the moment, I'd say around 75 to 80% of them feel like they are in a good place with Consumer Duty, making sure that they are ready for the 31st of July. There are a number of them, though, who I'm finding are a little bit behind where they should be right now. And the thing that's standing out to me is probably the size of broker. So the bigger brokers who have a compliance team in-house seem to be ready for where they need to be. It's the ones who maybe don't have quite as much resource, having to use external companies who have been given a framework of what they need to work to, but being a smaller company and having less resource, they're obviously covering many different areas within their business. And this is just another part of what they're trying to do, especially to make sure they're ready for the end of July. So they might be a little bit behind the curve, but no one's kind of panicking that they're not going to be ready for it. But yeah, we are just seeing kind of a different shift between the bigger brokers and the smaller brokers in our industry.
Yeah. And then Sheraz, I suppose you're kind of view on the state of readiness in terms of, like, I mean, do you think we're going to be ready for the end of July? Do you think most people are going to be ready, or do you think there's going to be some people we can caught out?
Yeah, so we within Quint we operate a company called Menevo, and Menevo is in effect an intermediary distribution for larger aggregators and lenders. So on kind of one hand, we've got about 30-40 aggregators who are out there, acting as brokers themselves, and on our lender panel we've probably got about 50 lenders. And actually, prior to the 31st of July, we've got the much more imminent deadline about manufacturers and distributors sharing the data that is required to allow them to fulfill their obligations. So I would say that I am expecting to be having around about 100 conversations about distribution, and I'm having 2 right now. So, and the 2 that I'm having are with 2 of the bigger players, and even within 2, these are 2 high street names, on the lender side, and even there, the state of readiness is mixed. So I'll give you an example. Right, it comes to what's your target market. I've got lender A who goes, it's credit. Everyone wants credit. My market is everybody. Hurrah! And then I've got lender B who are extremely specific around our customers live in these areas, they're this age branding, they're looking for this type of loan, and it's that, and it doesn't take an FCA crystal ball gazer of much expertise to be able to tell one state of readiness is kind of far better than the other. So I'm frankly really surprised, Chris, that I'm sat in the end of March and I'm expecting to have 100 conversations about distribution, and I'm having 2, and it just makes me think I'm going to be really busy in April. I also suspect that of the 98 conversations I'm due to have, not all of them will start in April. So I think evidentially one can conclude from that I think some firms are at danger of missing the first deadline.
Yeah, so it sort of barrel down, and then after the deadline, there's going to be sort of like panic's going to increasingly set in potentially as well. So as we go down, I mean, what do you think the impact's going to be on lending practices with the Consumer Duty coming through, particularly the pieces around sort of like understanding what customers' outcomes are, pursuing their financial objectives? I mean, does that put burden on on lenders? I mean, what's going to be the impact in terms of like how that affects the dynamics of the lending industry? Do you think? I mean, Jason, I don't know if you got a view on that.
Yeah, I think it goes back to that point I think everybody's made on the panel to now, is that we have some people that are taking this seriously and are well up to the mark, and there are others that are kind of further behind. And I think it does differ depending on whether you think this is radical change or is this just rebadging. Because if it's rebadging, then there will be fewer changes. If you think that this is radical change, then there will be more changes as people go through, from start to finish in terms of the customer journey. How does the customer come to you? Where do they come from? What have they seen up to that point? All the way through to if things go wrong and that debt is sold on, who's going to take that on? What kind of experience will the customer have? All of that journey, people are looking at that. Will certainly, there will be innovation. But where people think this is just a rebadge, I think that we will see less innovation.
Do you think there's a sense around like not wanting to see it as radical change because your business model won't necessarily support it being that in terms of investing in it?
I think there is a sense of convincing yourself that you're okay, and therefore you don't need to. And for smaller members, that might be, I don't have the resource. We've talked about already. I think James is talking about the difference between broker sizes and what resource one person might have against another company. So I think there's something in there where if you think you can't do it, you think you don't have the resource. Unfortunately, I think some people may try and convince themselves, don't worry, I'm 100% compliant already against treating customers fairly, and this is only a slight change on treating customers fairly. So I don't know. Some of it is that kind of like, I need to believe this.
Yeah. So James, I'm just kind of interested in terms of like, what do you think the impact's going to be? Talked about the lender impacts there, but what about the customer impacts? I mean, what do you think? How do you think the customers are going to see some of the process changes that are put in place?
Well, essentially, obviously, consumer duties there. Consumers should get kind of the communications that they can understand, the products and services that meet their needs and kind of offer them fair value, and also the customer support they need and get it. So with regards to the customers, I think they should see it as pretty positive because of the transparency that they're going to be getting through consumer duty. I think there might be a few concerns or reservations further down the line for the customer, just about increased costs or changes to existing financial products or services based on consumer duty. But overall, I feel like customers are feeling quite positive, and that just goes back to my brokers as well, and the brokers how they're currently kind of lined up with getting this in and having it in place. They're not seeing that there's going to be, and again, going back to Jason's point, there might be some there who are taking it more seriously than others, but some of the brokers really aren't seeing that there's going to be much of an impact for the customer based on this. Obviously, transparency and the outcomes are going to be there for them and hopefully going to be better for the consumer and should be better for the consumer. But the overall consensus I'm getting from my brokers is there shouldn't be a massive impact for them.
I mean, if there's a lot of change that needs to be done, I mean, it could put quite a lot of stress on business models. I mean, or stress on processes. I mean, but often we're just talking in the last session around how sometimes that stress, a bit like we saw during COVID, can actually create a lot of innovation that's going on. Do you think the regulation is going to sort of stifle innovation, or do you think it's going to sort of promote innovation? Because there'll be a problem that has to be solved. There's going to be a burning platform that has to be solved. And Sheraz, you're saying like you're not having the 90 conversations you need to. But do you think it's going to sort of kickstart extra innovation, or do you think it's going to be sort of like, well, we've got to do it, or it's just sort of cause people to even exit the market?
Yeah, I think we'll see two tracks. I think we'll see track one, which I kind of don't want to use the word dinosaur, because that kind of has certain kind of, but then I've used it. But I guess you're going to go track one that says, and to Jason's point, this is just TCF badged up, because they see, they will see the FCA saying some of the same things, but won't understand that some of those same things now have kind of far greater prominence in that armory. And I think those are the firms that will not innovate, because they won't feel the need. And then in 2 or 3 years time, there'll be a thematic review on one of the consumer duty strands, and they will, suffer some difficult consequences. And then I think you will see a second strand of lenders who are really trying to do things differently. Yeah, so already we're seeing some different models in how people kind of think about finance. There's salary finance, there's subscription finance, there's increasing use of kind of open banking and moving away from kind of credit. So I think I've always been a fan of principle-based regulation. I think it's great. I think it gives firms the opportunity to articulate for themselves why they think what they're doing is good. So I do think you have this new set of firms coming up that are going to innovate, and I think that's what will happen, Chris. There'll be some firms just can't innovate because they don't see the need to innovate, and there'll be other firms that continue to feel liberated by this kind of principle-based regulation.
Yeah. I mean, so just on, part of consumer duty is going to be around evidencing. So some of the feedback I've definitely heard is really around, as much as you can look at it around the customer journeys themselves, also the evidencing you've done the right piece. I mean, how difficult is that going to be, and what's the readiness of that around there? I mean, I suppose it falls into the same kind of split, I suppose, those who've got legacy systems versus those that have got more modern systems and starting to evidence it, really. But I mean, what do you think? What do you think is that going to be the main problem? Do you think, outside of the process design? I mean, James, what's your kind of view? I mean, purely on the evidencing piece, is there a long way to go?
Yeah, and I had a conversation.
Yeah,
and I had a conversation a couple of days ago with one of our brokers, and evidencing to them seemed like it was not an afterthought, but something which they haven't got in their forefront of their mind yet. They want to get everything else lined up, but obviously with the thought that once they've got that, it's how they're going to then provide the evidence through the data collection, analysis, the kind of documentation that they need to. So again, just going back to the brokers I deal with and speak to, I feel like they might be a little bit further behind with where they need to be with regards to making sure they've got this ready. And again, going back to kind of how they're going to now approach this with how they're going to note it down. I think a lot of it is kind of legacy stuff there that you mentioned, that it's not, I don't want to use the word archaic because some of these people haven't got the tech in place to do this, but it is still putting stuff down on kind of Excel and Word format rather than having anything else in place at the moment. So I do feel like they do need to look into that a bit further of how they're going to do that once it does go live.
I mean, one of the challenges, Sheraz, you mentioned around principles-based regulation. I mean, one of the challenges you can have is, right, how do you evidence that you've got your adherence to the principle? And it can be a bit of the eye of the beholder in terms of whether you're being reviewed or not. I mean, how much is that uncertainty going to affect? Obviously, it can benefit the consumer, but I mean, how much of that uncertainty do you think that can sort of affect how much cost gets put on? I mean, Jason, I know we were chatting a bit about that a little bit earlier around does principles-based really help? And where can it cause complexity? Jason, you're on mute still.
Sorry, I thought you were going elsewhere. I think for me, I mean, I take a quite contrary view to Sheraz on this. I worry constantly about principles-based regulation. I worry about some of the moves that are ongoing to move even more over from the Consumer Credit Act into principles-based regulation, but maybe I'm scarred by some of that experience, and also, what some of our members tell us about how difficult that process can be in terms of explaining the position that they've taken and how they've got to that position, and particularly it's open to the eye of the beholder. It's kind of compliance can be in the eye of the beholder, and unfortunately, it does just open things up to subjectivity, and we see that in terms of the way that different sectors are treated around different principles that are applied in different ways around different sectors. So I'm not a big supporter of that move. We're going in that direction. We're not going to stop it. We're not going to reverse it. But I do think that we need to be aware of the risks that are there.
Chris, can I respond to that?
Yeah. Go ahead.
So actually, I think what tends to happen when people think about principle-based regulation is that they start doing first principle-based expositions. Yeah. And they go, because it's principle-based regulation, our response to justify something must be based around principles. And you end up in this sort of, the phrase I've used recently, sort of, knitting fog together, right? Actually, what I found works well is using evidence, yeah, and say, well, actually, in this particular principle, here are the key metrics that we think are indicative right now. This is our evidence, yeah, and then kind of building it up from there. And also, I think the second point on that is having the courage of your convictions. So in my experience with regulatory interventions, look, sometimes the FCA is almost like a non-exec director, right? They're asking you difficult questions, not because they actually have an answer, but actually because they want to test the courage of your conviction. And stating something with some conviction and with evidence to back it up is I've seen it work well, providing that you can connect the evidential elements back to why it supports the principles. Where I've seen things not go well is where people think, well, these are the key metrics because I think they're the key metrics because they've always been the key metrics forever, and I've spoken to the FCA and they'll say, well, our position has changed as the evidence has changed. We're 5 years down the line on some stuff, and we thought it was we thought it was true 5 years ago. Now evidence has changed. We think something different. So that's entirely rational, right? But I've seen other lenders kind of take a view. Well, you've changed your mind. Woe is me. Whereas actually, it's entirely rational to change your mind as evidence changes. And so I think that's okay. Yeah. So that's my response back.
But I think I'll respond to that by saying I agree that one of the great advantages of principles-based regulation is that we can learn from the experience, but we're not judged on going forward. We're then judged on what we did previously, and we didn't have that experience, we didn't have that knowledge, and yet the FCA will then turn around and say, okay, now we've changed our mind. You can accept that, go back 10 years and apply that and see what happens. And of course, the business collapses under that because that's
hard cases make bad law, right? I think there's a danger that we look at the whole universe of regulation through the lens of one hard case. Yeah. So I hear you on a particular example. Some people feel a particular way looking at that fact pattern, but I've looked at the same fact pattern and kind of come away thinking something differently from it, which I think goes, which I think is indicative, right? If people with the same set of scars can look at the same problem and come away feeling slightly different about it, then I think that tells us something.
So how should we think though about evidencing and evidencing packs to make sure it stays relevant? It reflects your convictions, but then you also need to make sure it then reflects the convictions of potentially the regulator as well to a certain extent. So you have to sort of think ahead. I mean, what's your kind of advice around how we should think about that, Sheraz? I mean, and it's beyond metrics. I was going to ask the question, well, what metrics are good metrics for outcomes? Because people are struggling with that at the moment. But it's beyond that, I think.
Well, I think it's, look, it's test and learn, right? Which is a terrible cliche. So let me just expand a little bit on it, right? So in my experience, it's A/B testing, so test and learn, right? So well, here's a set of metrics that tell us something. Well, here's a different set of metrics that will either corroborate that position or disprove that position. So in a way, it's showing that you have a set of metrics that you think they work, but you are open-minded enough to know that just because you pluck these 10 metrics out of the possible set of 100, that you're not then betting the bank on it, right? And you go, well, here's a different set of 10. So we do A/B testing all the time when it comes to making credit decisions, and we see it's great for doing credit decisions, right? We're always looking for different correlation factors. We tend to not like to do A/B testing when about compliance things, because actually I think we're a bit scared of finding out that we don't, I think that's what starts to happen, Chris, right? We get scared of finding things out that we don't want to know, and we then construct a set of metrics that give us that confirmation bias that we're right. So I would say the best way to handle the FCA and to kind of keep ourselves on the front foot is to set up a structure whereby your metrics are not giving you confirmation bias, and actively look for ways to avoid confirmation bias. And by doing that, you're more likely to be successful.
Yeah, how much of a theme do you think that is? I mean, certainly you see it around. People seem to be. I mean, they're quite scared to not be compliant, for sure. I mean, for valid reasons. I mean, how much do you think that drives confirmation bias, or drives behaviour maybe not in the right way? I mean, is that a valid theme, Jason? I'm kind of interested in what you kind of think in terms of that. I mean, because we are running. Not running scared, but I mean, there's obviously, people want to make sure that they are being compliant and they're doing everything they can, which can then cause problems with some of the principles base, because you can't say 100% uncompliant.
I think where we are, I mean, we could have an entire session on this. I mean, where this is just one element. We could have an entire session on principles based and what it means and how it goes and how it develops and the advantages and disadvantages. And I do think that it's also kind of the nature of the organization as well. I mean, the size of the market, the number of companies that are being regulated, the number of sectors and subsectors, that I think it does mean that the FCA often firefights, and that gets us into a position, a difficult position where they firefight, and when they do find problems, they come down like a ton of bricks on those problems, and that doesn't help elsewhere because there's not an understanding of the expectation of the FCA. All they can see is the kind of interventions and what they look like, and when things go wrong, they don't see any kind of positivity and kind of engaging constructively with the FCA, just because of the nature of the FCA.
Okay. We'll move off consumer duty. We're just coming back to back to James, just in terms of, like, if there are 5 things you sort of recommend that people have got to focus on now. I mean, what do you think the theme should be, at least anyway, if not 5, in terms of getting ready for, you got the April deadline, as Sheraz correctly said, and you've also got the July deadline.
Yeah, look, I won't take up all 5. I'll take a couple and then open it up to the floor as well for anyone else who's kind of got an opinion on what 5 things. But
5 was a big number.
I was going to say,
one or two.
I'll reel off a couple and then, like I say, I'll open it out to others as well to have their say. But from our side of things, a couple of the areas that need focus right now are, training for staff to ensure that kind of all employees understand kind of their responsibilities under consumer duty, so they can kind of relay it and be transparent to the customers. I think also it's just a case of the culture as well within the brokers and around the staff, making sure that they have got the right culture and got the right framework, just so they're ready in time for when April and July come around, that they are saying and doing the right things they should be doing and putting, obviously, the customer kind of at the heart of their business.
Certainly been a lot of noise around culture, I think, over the last couple of weeks, just in making sure you've got the right culture. I've seen a couple of stories coming out from the FCA around that, making sure that's embedded through. I mean, consumer duty, we spent the first half of the call talking about that. I mean, that is a big thing for us in the industry, but it's not the only thing. I mean, there's the Consumer Credit Act reform that's coming through. There's BNPL. I mean, and Jason, I think you were giving me an update last time just in terms of where we were in terms of Consumer Credit Act changes, because I know there's a revision of that coming through, wasn't there?
Yeah. I mean, there's a consultation process that's kind of underway. The first kind of phase of that has kind of come to a close, but this is a process that will go on for a long time and involve different organizations. Firstly, the Treasury, and then the FCA, when the FCA starts talking about what that looks like in terms of rules and regulations. So we're kind of at a really early stage, and it's kind of not clear yet about what this might look like or where this might end up. And we know that there are some areas of interest that have been identified by everybody, and that's things like, how do we engage with customers and when do we engage with customers? Things like communication have been issues that have been picked up by both lenders who are kind of worried about some of the ways in which communication has been stuck in the 1960s, 1970s kind of mindset, and also kind of obviously consumer groups are just as interested in whether that communication is right and proper and gives a true position for the customer. So there's that, and I think we will find some. It'll be interesting to see the consultation responses, because I think we'll find here or there some kind of little things, technical issues that should change, and that none of us kind of realized was there. And I think it's kind of interesting. We know that there are some big issues. I think there is more to come in terms of understanding what the true agenda will be, or the true program will be.
And what about BNPL and sort of bringing that more into the fold? Where does that?
Yeah, and I think this has been done at the same time, slightly different. It's a different consultation, different process, but it's been really interesting for those of us that are in consumer credit and been looking at regulation and how regulation is developed, because, while the sector has been traveling at some speed, the regulation has been traveling much slower. BNPL provides a really interesting dilemma for the regulator, because for as long as I can remember, the regulator has been talking about friction and the need for friction, the need for borrowers to stop and think about the consequences of their borrowing, and to think about what that might look like and how that might impact them. And I think with BNPL, the perfect journey has no friction at all. It's frictionless. It's all about it's no longer about the financial product. It's about the retailed product. And I think that is a really interesting kind of dilemma for the FCA, because they've been talking for so long about people stopping and understanding and introducing that friction. And now with BNPL, it's like, no, we want to get rid of friction. We want to keep it as smooth as possible. And I think there are people that want to continue that model. I can see, government ministers and various other kind of stakeholders that are keen for BNPL to play its part in kind of that consumer economy that we have. But it's a really interesting dilemma for the FCA.
Well, especially when you go back to outcomes and understanding what people's outcomes should be from a particular loan. If it's frictionless, do you have as much of an understanding as it was if it's not frictionless?
Yeah.
Sheraz, I know you've been a sort of a big digital advocate. I'm kind of interested in your kind of view on that. If there's a way of sort of automating it, or if there's a need to put friction in, and then particularly maybe just commenting about BNPL and that whole kind of market. Because I think they've started sending some data to the bureaus as well.
Yeah, I think I actually agree with Jason on this a fair bit, which is unusual. The perfect buy now, pay later journey is frictionless, and the act of bringing in regulation increases friction. So you just begin to have a tension there in terms of the ideal business model for commercially and what the kind of regulator wants. I think what's interesting is friction is dynamic, or the need for friction is dynamic. Yeah, because, and I'm going to be slightly controversial here. Look, the key thing is people's income. So if you have high income, so actually there's quite a lot of evidence that suggests that people's financial literacy, or as a phrase that I use now, financial fluency, is actually pretty much the same regardless of your income level, right? We're not very good at doing maths as humans. We're not good at managing risk. There's a landmark study done in the States where you sort of ask a bunch of people, look, I'll give you 100 quid and the interest rate's 2%, will you have more than 100, the same, or less than 100 in a year's time? And half people get that wrong. And that's really simple stuff, right? I think if you've got a high income, your income just mitigates for your lack of financial fluency. Yeah, so it's easy. I think if you've got a lower income, actually your lack of financial fluency has more of an impact. Yeah, and that's where they want that kind of friction, is where the customers need it. If you're high income, all you're doing is choosing how you want to spend your money, right? So actually, whether you're borrowing or not borrowing, your financial health is relatively agnostic of your medium of consumption. If you're a lower income person, then I think your financial health is very dependent upon how the medium, the product through which you exercise your consumption. And actually, that's a difficult thing to say if you're a policymaker, right? So I think a bunch of the stuff we talk about is trying to avoid the elephant in the room. And actually what we're talking about is income inequality leading to policy problems. And consumer credit is an expenditure side tool, yeah? And so, I mean, Jason and I have had this conversation a number of times to say, you know what, actually we talk a lot about how can we control on the expenditure side of things, whereas the key driver for it, I see it as being income side. And I think that's kind of what Nirvana looks like, is looking at what a customer situation is and then making that kind of decision on the customer circumstances. And look, that's what you do in mortgages, what you do in pensions, what you do in insurance. You do that kind of fact find, and you kind of give. And consumer credit is non-advised, pure transaction thing. So to me, that's where the answer lies.
Your statement kind of links across to some of the collections conversations we have around when people are under financial stress. Actually, the people who have slightly lower incomes seem to be better at budgeting. And they can actually be pretty good at budgeting because they're used to doing it and they've got the skills in doing it, whereas the people who are on the higher income probably don't need to do that, to your point. And the challenge we're seeing is sort of with the incomes going down, it's sort of requiring more people to be better at budgeting and managing the money more closely, which sort of links in a little bit to what you're kind of saying. I mean, James, what do you think about sort of that whole sort of frictionless piece, and when you need to sort of have intervention in terms of lending, particularly in the motor finance space? I mean, you're sort of seeing ever more players, like digital motor lending seems to be sort of like been a bit of a theme over the last sort of 12 months or so, at least, in terms of like just trying to make it as seamless as possible, almost like buy your car from an app. Is that? Do you think the frictionless, has it got its limits in terms of when you actually need to see it? You can almost like making a very big decision very, very quickly.
Yeah, and I'm just going to go off kind of like the experiences I've kind of had with BNPL, how I kind of feel about BNPL as well, just to jump in on the points you're talking about there. I think it, as a product, I think it's an absolutely kind of fantastic product if it's used correctly. I feel like for people who, the economic world we're kind of living in at the moment with regards to cost of living, I think that it does allow, obviously, the consumer to get the products they want, spread it over a small period of time. From our point of view, though, in motor finance, it's a case of how the broker wants things to be done as quick as possible. As a lender, the way we look at it is we're looking at bank statements, we're looking at various different things, so OBLs. And the problem that we're finding is when there's multiple BNPLs taking place on that customer, it's taking up obviously a lot more time to underwrite those products. So then you start losing the speed. If obviously CRA can look at that and be able to come back with something to help out with regards to BNPL, then I think it's something which will help us and will help the speed of turning around decisions and giving that customer again the journey they want from applying to getting the result they want at the end of the day. Like I say, personally, I think it's a really good product if it's used correctly. But if it's used incorrectly and people are making multiple purchases, whatever it is, whether it's a small purchase and spreading out over 3 months, the way most people buy when they buy retail these days now is, or they have done, is buy 2 or 3 products, and they'll be sending 1 or 2 of them back based on size or color or whatever the issue might be. And that's where I think people might get themselves into a little bit of trouble with regards to buy now, pay later, because, if they haven't got that product back in time, then they might be getting charged for that. For instance, if they've bought 3 products and they then end up wanting only 1, but ended up having 2 of them, then that's another payment that's going to be going out. So it starts getting used a little bit incorrectly down that as well. When people start getting themselves into a little bit more trouble by doing that.
But it does sound, even from your experience in the motor sector, that like speed of decision making is still obviously a big theme. And it's sort of like the introduction of friction sounds like it needs to be tactical, if anything, to really understand outcomes.
Yeah,
speed of decision making from loans.
Yeah, 100%. Yeah.
Okay. So the other topic that it sort of falls under here, I suppose, is CMCs, claims management companies. I mean, there's been a big sort of that's been a dynamic in the business for a while. What lessons, I suppose, have been learned, or where do you think the next focus could be? And I think, Jason, you're probably closest to some of that from your members' point of view. I think largely to a certain extent from an experience point of view.
I think
where do you think we're going?
I think affordability has been a big issue and not just in one sector, but across a number of kind of sectors or subsectors. it continues to be an area of concern. We always knew that CMCs would look for the next PPI, and some of that was easier as millions of us had given CMCs our information to carry out PPI claims. And those lists have undoubtedly been the basis of a number of campaigns by CMCs looking at other issues like commissions in motor finance, affordability, kind of sustainability of credit and things like that. So there's a number of areas where I think they're starting to, or they have been looking. Just as bad are those kind of automated complaints where we have drop-down menus and tick this box if this applies to you type of automated complaints, because that's probably why our members in a batch of complaints, it's not unusual to see 30 or 40% of those complaints or DSARs come from people who have never had a loan with that company. And it's because it's been a drop-down menu and somebody says, oh, I think I recognize that company. I'll tick it. I must have had a loan with them, or I must have been involved with them at some point. So, that's like 1/3 to nearly a half of complaints and DSARs are coming from people that have never had a loan with that particular company. And then we have duplicates as well, where even in a batch of 100 complaints or 200 complaints, there'll be a reasonable number of duplicates in there where people are seen to be complaining twice, or have complained already at a previous point, had their case adjudicated, dealt with, and they're back with another complaint on the same issue. So all of that takes time to go through. That's not without cost, and I think so. There are a number of there continues to be a number of bad actors out there in the CMC world, and I think for the regulator, it's a whack-a-mole. One gets whacked down and another one pops up, often surprisingly with the same database. I wonder what happened there. So you kind of knock one down and another one arrives. Knock one down and another one pops up. So I think it continues to be a problem, and I think it's. Affordability has been one area, but there are a number of areas where CMCs.
Do you think the consumer duty changes that are coming through potentially opens up a further angle if we're not careful, whether you've evidence that you're really looking after my best interests or not?
It's a conversation we've already had with the FOS, and the FOS. I think the last time we talked to them, their belief was that the consumer duties in themselves will not be the areas of complaints, that it will still be the areas of complaint that we've seen in the past. It's just that the consumer duty will probably be mentioned as part of one of the reasons why that individual might be complaining. So, and I think that there's some validity to that we might just hear the consumer duty mentioned in every single complaint, but I'm not sure that consumer duty itself will be the complaint.
Yeah, so it's not driven by the actual legislation itself or the rules themselves. It's just used as another reason for. So we've got to be careful with how we see that then.
Though you could see things like affordability. Does that become price and value? And do people talk about more like that rather than affordability? Do you kind of say, well, even if it was affordable, it was the wrong price.
Yeah. Okay. I mean, and I suppose the last kind of aspect, I suppose, is things like AI regulation. We haven't talked much about AI and sort of like using data. We have on the previous ones. I mean, there's lawmakers in other markets that are starting to talk about regulation around AI. Transparency around decision making, those kind of things. I mean, is that something that we should prepare for? Do you think in the UK? I mean, there isn't legislation here beyond GDPR. I don't think it's been talked about, but it's definitely being talked about elsewhere. I mean, it's something we need to look at. I mean, Sheraz, maybe I don't know if you've got a view on that in terms of like regulation around AI. Will we start to see some of that?
Well, I think it already exists. Actually, if you look at the context of GDPR and some of the rules, so actually, some of the GDPR isn't there about when you're making automated decision making, that you need to be transparent that you're doing it. And a thing that I do, because I'm geeky like this, I look back at when the first seed of that was sort of born, and where you can see it kind of growing. And I remember the Consumer Credit Directive changes coming in, and them saying, if you've used the bureau to make a decision, remember that. If you've used one, you have to let the customer know. Remember those heady days when it was optional. So I mean, it's interesting, because AI, look, it's predominantly a complicated algorithm. So if you wanted to interpret things in such a way, you could say that there's an obligation to sort of do it now. So I think it will happen increasingly. And then I think, you know, you're seeing it in different parts of the overall FS sector, how instruments are more complicated than the human mind can grapple with, because it's algorithmic and AI led, and you kind of got the situation where look, everyone knows, you know, you couldn't look at Credit Suisse's balance sheet and there's not a single person in the world that can understand it, yeah, because it's so complicated. You know, we see that time and time again, where we let systems create instruments that no human can understand, and then when something happens, it all comes crumbling down. So I think it's inevitable that regulation will have to go and address that, because I would say that's probably the single biggest contributing reason to financial volatility of the last 15 years.
Yeah.
AI making the system more complex than we can understand, and when something unexpected happens, we don't know how to cope.
And to add on to that, I mean, of course, one of the principles is you need to be able to explain this to the regulator. You need to be in a position where you can explain to the regulator what happened and why it happened. It's one of the basic principles of the FCA. And how can you do that when it's all happening behind? I mean, I'm a sci-fi fan, so my entire hobby around reading sci-fi tells me of the danger of AI. And we say this one thing. For one side, but I agree with Elon Musk, which is unusual for me. But, you know, I was brought up with Ian Banks's books on culture, Samaritan, Skynet in the Terminator movies, even back to War Games and Joshua asking that question, you know, shall we play a game? I mean, I'm hoping that the AI of the future is not going to ask me whether I want to play thermonuclear war like Joshua did. But, I mean, we can already see AI and machine learning some bad habits. So there's machine learning tools in the US where they've taken HR recruitment tools, where they've taken all the data the company has given the machine, and the machine has identified that white men from Ivy League colleges have the best performance reviews in the company. And therefore, the machine has then said we should go and find more white men from Ivy League colleges, because all the evidence shows that that's the way we should go. And, you know, that's where we got. And I mean, closer to financial services, we know that there are pieces of work being done in America that looks at lending to Black communities, and the fact that if some of the learning tools that have been set up are saying to lenders, don't lend into these communities, because the statistics show that it's a bad decision to make. So I maybe Skynet has kind of absolutely distorted my view of the world, but you know, I think we should be really careful about AI and where it takes us.
I mean, and there I was looking at the EU legislation or discussion, whether they were talking about, you know, prohibiting some sort of data sources like things like facial recognition outside of governments. I mean, it was being prohibited around that. So it was like they were starting to put guardrails around how far some of the data can go, and whether that sort of like stifles innovation or whether it actually creates innovations in other kinds of ways. But it feels like there's some guardrails at least starting to be thought about, if nothing else. And just on sci-fi, completely aside, the one thing we never see in sci-fi films, at least the ones I see, is the fact that everyone going around with their tablets is actually on TikTok or on social media, which doesn't seem to have come through the sci-fi from the 80s and 90s. It felt like so.
Wow. It's dystopian, isn't it? You know, it's when you walk around outside, everyone's just on their phone like this, entranced. You know, I'll send you some cartoon sci-fis, Chris, where maybe my younger than yours, but you can see that people are sort of a little tractor beam emanating from the device.
Anyway, we digress. I mean, so I mean, I suppose to finish off, I mean, where do you think that, I suppose, regulation's going to really come from here? I mean, what do you think the outlook's? I mean, there's a pretty packed agenda as we've talked about. I mean, where do we go? I mean, James, what's your kind of view in terms of like where does it take us from here? I mean, what do you think some of the themes are going to be?
Well, I think with regards to regulation, we need to continue to put kind of a customer at the heart of everything. You know, as a business ourselves at Billing Finance, that's what we look to do, and I think it needs to continue kind of in that vein as well.
Yeah, Sheraz?
Price. The regulator is now a price regulator. They did it with PPI originally. You know, if you look at the detail on PPI, the minute they started doing alternate redress, they say you could have sold it, but if it was cheap, it would have been okay. The regulator loves the price intervention they made on high-cost short-term credit. They made a price intervention on the sale of general insurance, and now price and value is one of the cornerstones of consumer duty. So I think the next decade will be us grappling with the fact that the FCA is now a price regulator.
Yeah, and just on that, I know in the next session we're going to talk a bit about digital lending technology, but sort of elsewhere in Europe they have interest rate caps as an example, right? And what does that do to a business model? So that's a plug for the next session. So price. Thanks, Sheraz, and Jason. What's your point of view?
I'm absolutely going to agree with James and Sheraz in terms of the trying to put the consumer at the heart of it, and what happens with price and value. I think is fascinating. I'll try and take something different, which is I'll be controversial and say actually there is a bigger conversation to be had also about what will this do to the relationship between lender and customer. Traditionally, we had a lender-customer relationship with the regulator as the referee that made sure, remember the days of the Office of Fair Trading. Was it a fair deal? Was it a fair trade? This is changing everything. Now the responsibility lies with the lender to make a good deal, and that is decided by the regulator. So I could have a whole hour of the philosophy of agency, and I don't really, if I'm being controversial, I don't need to focus on the customer anymore. I need to focus on the regulator's view of the customer. If I can persuade them, that's the most important thing. It doesn't become that dialogue is not with the customer. The dialogue is with the regulator. I need to persuade them that I'm doing what's right for the customer. So if I was being controversial, I could say that. The idea of agency has changed. That's a bit of a philosophical place to end it, but it has changed. We're no longer talking about a customer-lender relationship with a referee. We're talking about a very different relationship, and that could be difficult for the future.
Okay. Very interesting. So yeah, there's probably an hour's conversation right there.
Yeah, 2 or 3, I'd say anyway.
So everyone, thanks very much to James, Jason, and Sheraz. Thanks very much for the discussion. Really appreciate it. Fascinating to say. There's lots on our plates and lots to talk about, and it sounds like there's a lot of changes going to come down the pipe as well, even in terms of how we interact with people as well. So it's fascinating. Thanks very much.
Yeah, thanks, Chris. Really interesting. Really appreciate the insight there from the panel. Yeah, and especially what you mentioned. I know you digressed into TikTok and stuff like that, but some of those things and how they might impact consumer behaviour as a result of what social media they use and all of that. I'm sure that's another conversation as well. I've just thought of. But yeah, thanks everyone for that session. As Chris alluded to, our next session will look at the future of lending technology. But that begins at 1 p.m. So anybody who wants to join that and hasn't registered already, definitely click on the link in the platform in front of you. But for now, I'd like to say a big thanks to Jason, Sheraz, and James for their time, and obviously Chris for chairing. And we'll hopefully catch up with everybody again soon for future events. Thanks a lot, everybody. Cheers. Bye-bye.
Thanks. Bye.
Thanks.